Okay, I guess we've got to about time, so we'll kick off. So hello and welcome everyone. My name is Rob Montague. I'm one of the team of international sales managers at Novia Global. We're delighted that you can join us today for the latest in our Pulse Advisor webinar series. Today we're joined by Justin Oliver and Dara O'Sullivan from Canaccord. Justin has been with Canaccord for over 20 years. He's Chief Investment Officer with lead responsibility for the multi-asset range of funds, as well as sitting on the Asset Allocation Committee. And Dara is the Business Development Manager with responsibility for relationships with financial advisors across Europe and Latin America. Now, when we have asked advisors for feedback on the subjects they'd like us to cover on these webinars, the main request has always been for market-related information to help answer client questions and client concerns. So over the next 35-40 minutes, Justin's going to examine the background to the current market and look to provide information to help answer some of those questions. For everyone registered today, we will be sending you a recording of the webinar, and we will make it available on the website. If you do have any questions throughout the presentation, please use the Q&A box. We'll collate those throughout the presentation and try and answer those for you at the end of the session. So without further ado, I will hand over to Justin.
Okay, thank you very much for the introduction, Rob. Good morning, everyone. Thanks for tuning in today. As kind of Rob alluded to, what we're intending to do this morning is it's been a really difficult year for financial markets. So what we want to do is just really examine what's happened, run through the reasons why that has happened, and then maybe actually put more of a positive spin on some of the issues, because it does seem that all the news is very much doom and gloom at the moment, and there are reasons to be slightly fearful, but actually maybe not. It's not, the situation might not be quite as bleak as perhaps is sometimes intimated from the news headlines. So we'll have a look at some of the concepts that we shouldn't forget when we're sort of managing money and implementing long-term investment strategies, and we'll have a look at some of the current developments in terms of financial markets. And I think there is some hope, as I'll sort of touch on, a lot to do with inflation in the US, and just some signs that actually I think the worst is past, and we can look forward, we think, to a more favourable investment environment moving forward. Just before we begin, just for those of you who are not familiar with Canaccord, very briefly, we're a UK-based wealth manager. We manage money for private clients, for institutions, for sovereign wealth funds, etc. Assets under management about 32 billion. But I think the most important thing is that we are all we deal with is investments. So we're not a bank, we're not a trust company, we haven't got an insurance arm. We literally just deal with every aspect of investments. That will range from execution only stockbroking. So if you've got a client who wants to buy some Apple shares, we can do that on their behalf. If clients want advice about whether they should be buying Apple shares, again, we can do that. And all the way through to discretionary portfolio management and discretionary fund management, which is what my role is within the firm. So with that, we'll have a quick look at the market background. And again, you will not need me to tell you it's been a really tough year for financial markets. So this is just showing a selection of assets and their performance this year in dollar terms, and basically everything is pretty much in negative territory, with the exception of oil, which is up in the year. Latin American equities have managed to eke out a positive return, but everything else is down, really led by the technology side. Technology was really strong in 2020 and was okay in 2021. but that area of stock markets have really suffered. I think the other thing to notice is that both bonds and equities have lost ground this year, which is in recent history is quite unusual. So obviously everything here in blue is sort of an equity market. Everything in grey is kind of bond market. And actually, if you're looking UK gilts, and obviously UK has had a few issues, but actually in dollar terms down 35%. Now some of that is currency related, but actually even if you strip that out, gilts, UK government bonds have been extremely weak. US investment grade bonds also lost ground. US treasuries have also lost ground. And another way of looking at that is just to look at the yields. Obviously yields move in the opposite direction to price, and you can see the massive spike up there in terms of yields recently, either in the US or UK. The upside is actually it is getting somewhat easier to deliver income, and actually we shouldn't forget that. Actually, it was very difficult for many investors to get an income without going into equity markets. Bonds have historically fulfilled that sort of function, and it is getting somewhat easier to do it. If you're having a look around at the bond issues, I think the other day I was looking, there's an HSBC bond, the HSBC, big, well-known financial institution, 2028 bonds. Your yield to maturity and that's just under 7%. So actually, I think that's starting to look quite attractive for some investors. But say it's been an environment where both bonds and equities have lost ground, and that is unusual. So what we've shown here is just all the quarters where both equities, in this case the S&P 500, and bonds, in this case the Bloomberg Aggregate, have both fallen during particular quarters. So going back to sort of 1976, there are 187 quarters since that time. Actually, on only 21 quarters have both bonds and equities declined on a quarter-on-quarter basis. And the darker shades here are where it's happened in consecutive quarters. So, if you're looking fourth quarter of 1979, first quarter of 1980. So actually you can see this year, even more unusual, in that we've had 3 consecutive quarters where both equities and bonds have delivered that quarterly negative return. So diversification hasn't really helped to protect against portfolio losses. And there seems to be a lot going on in terms of financial markets and the world more generally. But what we're trying to make the case here is there's always things going on. There were always things to worry about. The headline on this slide about events, my dear boy, events, was actually came from UK Prime Minister, former UK Prime Minister Harold Macmillan, when he was asked what the most difficult thing about being a leader and the UK Prime Minister was, what was the worst thing he had to contend with. It was all about events. Those are what we have to try to see through. And I think it's also noticeable that we have had periods like this in the past. Just taken a selection of other events which have caused equity markets a bit of angst, and it does pay sometimes, most times, just to remain calm in the midst of the storm. Or a year after the event has finished, equity markets have typically gained back a lot of the ground that they've lost. And from here, again, I'll take a look back at the last really events that we had to cope with, the global financial crisis of 2008, 2009. What we're going through at the moment does seem quite serious. We've got an inflation problem, we've got a cost of living crisis. But I would argue that the situation now is nowhere near as bleak as it was in 2008, 2009. With the financial crisis. Then we were very much questioning which bank would survive, which banks would survive, which financial institution might collapse. There is nowhere near the amount of stress in the financial system that there was back in 2008, 2009. We are going through an inflation problem, and whilst it is uncomfortable, there is a fairly easy way of dealing with inflation problems, which is what we're going through at the moment, which is basically raising interest rates to try to dampen down that inflation. The reaction from financial markets is not always good in that sort of environment. But again, we're not in that sort of same financial stress that we might have been 12 or 13 years ago. What's caused the volatility? Again, you won't be surprised to hear it's been all about inflation. It's all about US inflation, quite honestly. So most of these slides that I'm going to sort of share with you focus on the US for a couple of reasons. Well, in the interest of time, for a start. But again, the US is still the world's largest economy. It matters most as far as financial markets are concerned, and everything's kind of focused on the US inflation picture at this moment in time. And what's happened is obviously we have seen a sharp increase in inflation following a period of sort of 30 years when inflation has not been an issue at all. I first began managing money back in 1994, and since then I haven't really known inflation to be an issue. We've known periods of higher inflation and lower inflation. There's really the spike up recently, and the reaction of central banks to that, which has caused this year's volatility. And I think it's this slide. If I had to distill the presentation down into just one slide, actually this is probably the one I would use, because I think this explains the movement in financial markets this year. This just shows interest rate expectations for this year and next year at various points in the past. So the blue line at the bottom here just shows where markets thought interest rates would be this year at the end of last year. So on the 31st of December 2021, markets thought that by the end of this year, actually interest rates would only be in the 0.8% in the US. And why is that? Well, actually, because everyone at the time, whilst inflation was high and was increasing, everyone felt that inflation would be temporary, it would be transient, and it would kind of all sort itself out. And the central bank, the US Federal Reserve, would not have to do much about it. The next line up, we can start to see actually the market's belief in where interest rates would have to go had markedly changed. There was an understanding actually inflation is likely to be longer lasting. It's not going to fall away perhaps as quickly as initially expected. And therefore the market's expectations for where interest rates would end this year had moved from 0.8% to about 2.5%. And then obviously by June, which is the grey line, again, a further reappraisement in terms of US interest rates. And really it's that shift up in the line which caused financial markets to be very weak during the first half of the year. Now, why is that? Well, if you think about it, what do bonds not like? Well, they don't like interest rates going up and they don't like inflation. Obviously, we saw both of those factors. What do equities typically not like? Actually, they don't like interest rates going up. Why is that? Actually, it's because rising interest rates very often precedes a recession, and during a recession, US corporate profits fall, and therefore stock markets fall as a result. So it's a shift up in that line which really caused the weakness over the first half. We did see a bit of a rally in markets from about mid-June through to mid-August, and that's really explained, I think, by the second half of that sort of grey line. And what that shows is that actually markets believe that whilst interest rates would get to sort of 3.5%, actually they'll kind of peak at that sort of level. And then by the end of, well, maybe the second half of 2023, and the Fed would be looking to reduce interest rates. They'd be looking to cut them because by that stage, inflation would have been broadly under control and or the economy had slowed down sufficiently that they could take their foot off the brake slightly. Now, we felt that was always unlikely. It was very, very unlikely that interest rates would peak at 3.5%, really, for the slide that we'll show you next. And in fact, that's proven to be the case because the yellow line there again shows what basically an up-to-date expectations for where interest rates will go. Has shifted slightly following inflation numbers last week, but there's a broad belief that interest rates in the US will peak at around 5% sort of March, April time next year, after which the Fed may well pause and possibly implement a sort of cut later on in that year. And I think those expectations are broadly right. I think that obviously we'll see a further 0.5% increase in US interest rates probably in December, a further 0.5% move likely in January time, and then the Fed may well pause for a while whilst they try to assess whether they've done enough. Why did we think that actually it was very unlikely that interest rates would peak at sort of 3.5%? It's really from this. And this just shows that basically the end of every interest rate tightening cycle in the US has ended with interest rates being higher than inflation. Where are we at the moment? Well, actually, we need to update this slightly, but we've got obviously interest rates at 4%. Inflation now 7.7%. So again, we're not seeing positive real Fed funds rate, which basically is what we need to see. I think inflation will continue to fall. It's not going to fall in a linear fashion. So we're not going to go from 8 to 7.5 to 7 to 6.5. There will be periods and months where we get a slightly better inflation reading, and we saw that recently with the latest inflation print, which came in lower than expected. And there'll be times when actually inflation perhaps doesn't fall quite as quickly as markets might have hoped. And actually that was the previous month's inflation print was not quite as good as markets were hoping for. So again, this just shows the Fed has got a little bit more work to do, and expecting a peak of 3.5% was always going to be unlikely. So that's kind of the background. That's what's happened, and broadly, why it's happened. I think what we need to do now is just let's focus on a few of the other things that we very often forget when we're being bombarded with so much noise from the news and financial markets. So what are some of the fundamental investment concepts that we think we should remember? Firstly, if you're worried about inflation, I think the best of the assets to own in that sort of period is equities. And why is that? Well, actually, it's because companies have the ability to pass on cost increases to their consumers, to their customers. And it's very often the passing on of those cost increases to consumers, which is behind inflation rising in the first place. So this chart just shows that the US inflation and earnings per share growth from the S&P 500. And again, the correlation isn't exactly 1 for 1. But actually it does tend to move in the same direction. If inflation is going up, corporate profits tend to be going up, and vice versa. Now, there does appear to be a massive divergence between inflation and earnings per share growth more recently. You can see obviously the red line has taken quite a sharp tumble while inflation has remained relatively high. Actually, I think it's noticeable. You're reading these off different axes. So inflation reading off the left-hand axis is about 7.7%. So near enough that 8%. So if you're reading earnings per share growth from the S&P 500, again, most recent print, it's again about 8% year-on-year rise. So similar sort of levels. I do think corporate profits are going to come under a little bit more pressure, particularly as the economy slows. But on the whole, what you want to be targeting is companies, sectors where they have a competitive advantage, for example, and they can pass on cost increases to their consumers. So that's concept number one. Actually, concept number two is there's always a temptation to try to trade in and out of markets, buy at the bottom, sell at the top, etc. Firstly, that's very difficult to do consistently. The other point we want to make from this is just show actually the cost of getting that trading wrong can be quite significant. So what this chart shows is that if you've gone all the way back to 1990 and you'd bought a US tracker, something which just gives you the performance of the US stock market, you'd bought it and then you'd gone away for 30 years, you'd not looked at the portfolio valuation, you came back in 2021, actually you would have returned pretty much 10% per annum in that period. And actually I think most clients, most investors would be very happy with that sort of return. But if you try to time the market and you'd miss just the one best day each year, actually in that 10% return would have fallen to 6%. If you'd missed the 2 best days each year, you'd fallen down to 3%. And actually, all it would have taken is missing the 3 best days each year, and actually your 10% return would have come virtually nothing over that 30-year period. So again, it is an old adage, but the best investment strategy should focus on time in the market, not on market timing. The other point to make is that, and it might not feel that way this year, but equity markets do go up more than they go down. So again, just looking at the daily movements of the S&P 500, the percentage of days the market's up and the percentage of times that the market's down. Actually, the market rises on 55% of the days, or it has historically, and over the long term has fallen on 45% of days. When the market goes up, historically, on average, it's made 0.4%, and when it's fallen by about 0.3 or 0.36%. Now, the difference between these two, between the charts and between the bars, might not seem much, but actually, when you compound these things over 1 year, over 3 years, over 5 years, over 10 years, again, you've got a very powerful tailwind acting in your favour. Yes, there will be extended periods where markets don't make money, but actually, again, over the long term, markets do go up more often than they go down. Other point, we had a look at returns from the US stock market when the Fed has been raising interest rates. Again, historically, if you look back, it hasn't necessarily been a bad thing for equity markets. These are all the annualized returns from the stock market during periods of rising Fed funds rates. There are periods of higher returns, so 24.6% at the end of the 80s, and period of lower returns, so 4% at the end of the 60s. But actually, historically, the market still managed to make money when the Fed is raising interest rates. But there is a reason why we all should be willing the Fed to be successful in their battle against inflation, and that's what we're really trying to show here. In that there's if you're looking at the price earnings multiples at various inflation points, actually, where inflation is at the moment would typically correspond with a lot lower price earnings multiple for the stock market. So if you're looking all the way back, typically whenever inflation in the US has averaged between 0 to 2%, the PE of the S&P 500 has been about 18.6 times. If it's between 2 and 4%, again, 17 times, the same sort of ballpark. But actually now we're kind of, the arrow needs to be updated, but we're broadly in that 8% sort of reading. But actually, what sort of market level would that historically correspond to? Well, actually, if you're looking at earnings per share for the US stock market, about $207 dollars, you times that by 11 times multiple, and you get a S&P reading of about 2,300. The S&P 500 on the 9th of November stood about 3,750. So arguably, if inflation remains at these sort of levels and that PE does revert to its mean for that inflation reading, actually the US stock market could have much further to fall from here. Now, that's not our base case scenario by any means. We do think that inflation will get back to that 0 to 4% level, but again, it does represent a danger for the US stock market. Other questions you can ask about, we mentioned that equities are a good or maybe the better inflation hedge. Are there any other particular areas that might interest us? Actually, US small caps have historically been quite a good inflation hedge. Again, here we're just showing the annualized returns during various decades, going all the way back to the 1930s, both for inflation and actually small growth companies and small value companies in the US. The best investment in this context has been US small value companies, which have outpaced inflation in every decade going back to the 1930s. Small growth companies have done actually quite well, although they did underperform in the 2000s when we were coming out of the technology bubble, and also in the higher inflationary period of the 1970s. But in general term, US small caps have historically been quite a good inflation hedge. So maybe that's something we should also consider in terms of our investment strategies. And one of the things that we do hope, and we've kind of seen this a little bit, is typically the fourth quarter has been the best quarter for stock market returns. This is all data going back to some 1928, and it is an average. So these will incorporate a really wide range of returns. But actually, if we average all out, fourth quarter is typically the best quarter for stock markets. So again, I would not be looking to exit positions right at this moment in time. So those are some investment concepts. We'll just turn for the final part of this presentation just to some more recent market developments. Again, focusing, I think, on the inflation picture, because that is all important. That will dictate what the Federal Reserve's response will be, and in a way that will dictate what happens as far as financial markets is concerned. I think the main message that we want to leave with you is that we do think we have seen peak inflation. Inflation would have peaked in the US at about over 9% early on in the year, and is starting to come down. So that's the good news. I think the slightly more, we'll put a caveat around that, which is that I think we're unlikely to see a return to sort of 0 to 2% inflation that we might have seen in the past. But actually, I don't think we need to get down to that level for the Federal Reserve to be a bit more comfortable about the inflation picture. If it settles down at sort of 3%, 4%, I think the Federal Reserve will be comfortable with inflation at that sort of level. And that's what we're hoping to show just from this chart. The Federal Reserve Bank of Atlanta splits inflation into sort of two component parts. The first is what they call flexible price inflation, and those flexible prices are the price of goods and services which can and do change in price very, very quickly and respond very quickly to market developments. And that was really behind the initial surge that we saw in inflation. And it's all related to the pandemic and the shutting down of the global economy and the reopening up of it again. We saw used car, truck prices, airfares, hotels, etc. The prices of them all increased on a year-on-year basis, quite quickly and very sharply. But you can start to see here that it is beginning to roll over now. And again, that was kind of mathematically it had to happen. Airfares could not continue to increase at 70% year after year after year. It's just not going to happen, because it would reach a stage where no one could afford to fly. So we're actually starting to see that roll over, and that's why we think we have seen peak inflation. The other reason why we think that we won't get down to that 0 to 2% inflation reading anytime soon really comes from the other side of the inflation component, which is what's known as sticky price inflation. And that's the price of goods and services which don't change very quickly, but when they do, the implications tend to be slightly longer lasting. So here, just think about rents, for example. If your rent goes up, it will probably only go up once a year, but similarly, it's not going to go down anytime soon. And that's where we can see that there are, some of those longer term, prices have increased and are remaining have sort of increased from about 1.7% and standing about 5 or 6% at the moment. So that's not going to go away anytime soon. So I think these lines will eventually converge, and there might be some softening in the overall sticky prices. But again, I would not be expecting a return to that 0 to 2% level anytime soon. The Fed can take some comfort from the fact that inflation expectations have remained quite modest. So the markets do believe that the Fed will get on top of the inflation picture, which is basically what they're saying. So if you're looking at either survey measures or market-derived expectations for inflation, again, it's remained relatively controlled, which is good. That's certainly what the Fed will want to see. They would be concerned if inflation expectations are getting away from them, if the market was thinking that actually inflation would still be higher in 5 years' time. Actually, the Fed would need to do some more work to try to control that. But actually, this is quite an encouraging picture in our view. And another encouraging picture is the fact that some of that surge in inflation we saw was due to supply chain issues, and some of that was because of China's zero tolerance approach to COVID. If you're looking at supply chain pressures, actually not as bad as they were. That's what both of these lines are showing. It's again not back quite to sort of the levels pre-pandemic that we might have enjoyed, but certainly nowhere near as severe as they were, albeit bear in mind a lot of this could change if China begins to or continues to lock down large parts of its economy. And again, although there is some indication that they are softening their approach to COVID, and living with it is more of an option as far as they're concerned. Also looking ahead, what matters? Growth. Growth matters as far as equities are concerned. On the left-hand side here are just economists' forecasts for GDP for next year. And again, it's a picture which is okay. It's not spectacular levels of growth, pockets of higher and lower growth, led by India and China. EU is expected to be quite weak. Actually, the US is not expected to deliver much GDP growth, slightly positive. There will be a recession, we're pretty sure, next year. The question is how severe that recession will be. As we're trying to show here, what the Fed is really trying to do is to try to engineer a slowdown, but not such a sharp slowdown to cause a very severe recession. And actually, the part of the economy that they're particularly focusing on at the moment is the jobs market. Because what they don't want to happen is for a wage price spiral to emerge. So actually, the US labour market has been incredibly tight, really for the past sort of few years, but even tighter at this moment in time. So actually what this shows is the number of job openings in the US. So the number of posts which can be filled and the number of companies which are advertising for jobs against the unemployment rate. So actually, at the moment, there are 10 million job openings and there are 6 million unemployed. So actually, if every single unemployed person in the US got a job, there would still be 4 million more job openings out there. So what the Federal Reserve wants to do is basically to close that gap to try to prevent a wage price spiral emerging, but without causing a massive spike in unemployment, which in turn would cause a recession. That's a very, very difficult balancing act to achieve. And quite frankly, the jury's out in terms of whether they will achieve it or not. Actually, historically, they haven't been very good at doing that. Rising interest rates very often precedes a US recession, but we'll have to keep an open mind in terms of that. Some slight improvements in the job openings. Actually, what we need to see is some bad economic news. Actually, the markets will take that positively. If we saw a surge in initial jobless claims or continuing claims, actually the market will probably respond favourably to that, because it shows that actually the jobs market is getting a bit more slack within it, and that as a result of that, the US Federal Reserve again can be a bit more measured in terms of their interest rate rises. As I said, a lot of what I've focused on is the US. The good thing about an investment strategy is that we're not forced just to invest in the US stock market. And in fact, what we would argue is that moving forward, so maybe in 2023, it might pay just to look at markets outside of the US a little bit more. And that's very much predicated on valuations. So if you're looking at the price earnings multiple of the US, it still stands at a premium to most other regions, whether it's Europe, whether it's Asia or Japan. So actually, I think those regions are becoming of increasing interest to us from an investment strategy perspective. And here we're just looking at the European valuations relative to the US. And bar for sort of period during the financial crisis, actually European valuations are as cheap as they have been relative to the US, as they have been in the past 15 years, well below their sort of average. Again, Europe has historically traded at a discount to the US, but that discount is more, and the gap is wider than it has been going all the way back to 2007. So yes, Europe's got a few issues that it needs to deal with. Obviously, it's closer to what's going on in Ukraine and Russia. Its energy situation is inferior to the US, but actually a lot of that, I think, is already discounted in terms of stock market valuations. The other thing to look at, you remember I talked about small caps and suggested that over the decades, US small caps have given you that outpacing or outpaced inflation. Actually, the good news is that you would also be buying small caps at a cheaper relative price than you would have done during previous periods. So again, just looking at Russell 2000, which is obviously US small caps relative to the S&P 500. Actually, yes, the Russell 2000 typically trades at a premium, but actually it was still well below its average over the past 15 years. So it might not be a bad entry point in terms of US small caps. So you've got the decision about where to invest geographically. You've got the decision about what size of company that you want to invest in. And also you've got the decision to make about what style of company that you want to invest in. And very much, again, it's coming out in terms of financial markets, is that growth versus value debate. Do you want to buy companies which are going to deliver you stronger earnings per share growth, or do you want to be buying shares and companies which are actually cheap and which are offering value? All the way up to really sort of the end of last year, growth has been a clear and decisive winner, and value has significantly underperformed, which is what this chart basically shows. The situation changed markedly this year, and value has begun to outperform quite significantly. Again, when I'm looking at this chart, it does suggest to me that the value rally could go further yet. Typically, value stocks, you'd be expecting them to trade at a discount to growth stocks because they are cheap companies. But typically that discount has been, you're buying them at sort of 75 cents on the dollar relative to growth companies. At their nadir, you could buy them at sort of 45 cents on the dollar. Even with the recent rally, it's still below 60 cents on the dollar, again, compared to its longer term average of 70 odd cents. So suggests to me that there is more to go in terms of that value rally. I'm not entirely sure that technology, which again is kind of the archetypal growth company, I'm not sure that will resume market leadership anytime soon. So just to wrap everything up, just put a few summary points. There are always positives and negatives that we need to take into account during when you're formulating an investment strategy. And I guess one of the messages I'd also like to leave with you is that actually the news doesn't have to be good for markets to make progress. Sometimes it just has to be not quite as bad as markets were fearing. And that was very much behind the recent very sharp rally that we saw recently. US inflation at 7.7% isn't great, but actually it was better than what the market was anticipating. And we did see a positive price response as a result. If I'm adding all up, what are some of the positives that we can take from it? Well, I think it's reasonable to expect a growth slowdown, particularly as the Fed are raising interest rates, but I think it might be mild. And actually, I think we can see that peak in US interest rates may well be in sight. I think, interest rates peaking at 5.25% seems to me to be a reasonable expectation. And if that is the case, and the Fed pauses and potentially begins to cut maybe towards the end of 2023, actually, I think markets will respond positively to that scenario. But similarly, while the US is tightening, other areas aren't. China is providing stimulus to its economy. Again, China's got many problems to overcome, and there's some fears about the regime in terms of China and what it means for the stock market. Some commentators are calling China uninvestable. I don't believe it is, but I just think you need to understand, what the Chinese policymakers, what they want to achieve, and invest on the right side of those moves. As I said, on the positive side, inflation, I think we have seen peak inflation. It will continue to decline, moving forward. And there are always opportunities out there from a stock market perspective. I think increasingly those opportunities are going to be outside of the US. On the downside, what should we be worrying about? What we should be looking at? I think company earnings are going to be a little bit vulnerable moving forward. The last results season in the US was okay, but it was very much boosted by energy companies. And we stripped that out, it wasn't quite as strong. So I think it's reasonable to expect company earnings to come under a little bit of pressure. Our belief is that we have seen peak inflation, but there will be periods where inflation perhaps doesn't fall as quickly as markets were hoping. And again, we've got to be humble enough to realise, this is our view at the moment, but things can change, and we might have to change our investment strategy as a result. If you're looking at the US stock market, it's still not registering as cheap. And actually, the price earnings ratio hasn't got down to the sort of level which would typically mark a bottom in the market. In very broad terms, that market bottom would be a sort of PE of about 11 times. We're still at 16 times at this moment in time. It's not to say it will definitely fall to 11 times, but I think you've got to realise that actually the US stock market isn't particularly cheap. And then finally, we've got the whole geopolitics situation, what's going on in Ukraine and Russia, and then fears about what that means and what the implications are for China and Taiwan. I would caution about formulating an investment strategy based around geopolitics. You might have a view that China is going to invade Taiwan, and therefore you just want to hold lots of gold and lots of cash within your portfolios. But then what happens if that doesn't occur? What happens if 6 months later China still hasn't invaded Taiwan? I would argue that some of those geopolitics or geopolitical risks have to be sort of dealt with as they occur, and very difficult to preempt them. If I'm looking, I was inundated with research the day before Russia invaded Ukraine, explaining to me why they weren't, why Russia wasn't going to invade Ukraine, and lo and behold, that's what happened. So again, just to take a little bit of care, certainly about some of those geopolitical developments, because actually there's very little that can be done, in my opinion, in advance of those. So with that, I'll wrap up. Thank you very much for your time. I think I can see some questions which have come in, which I'll answer if that's all right with you, Rob.
Yeah, absolutely. Please go ahead.
Yeah, so one of them's just saying you've commented on US inflation, but thoughts on UK inflation. Yeah, the situation in the UK is not quite as favourable as it is in the US. Obviously, latest UK print at 11%. Again, look, the UK economy has many challenges to overcome, and actually it's suffering for inflation because, well, part of it is also currency related. So the fact sterling has been weak means import prices become a lot more expensive. There are labour shortages in the UK. Lots of areas seem to be being short of workers, and that's all feeding through to that those higher inflation readings. Our general take on it is, yes, I think UK inflation will eventually come down. Again, the Bank of England are going to raise interest rates come hell or high water to control inflation. They've warned that the economic impact of that will be very severe. But again, they are committed to getting inflation down. I don't think it will be quite as easy a path as perhaps it is in areas like the US, where I think they're nearer to their sort of interest rate peak than the UK is. The UK has got many challenges to overcome, labour shortages, I think, being one of them. Next question from from Stephen, given infinite money printing for 14 years has created asset bubbles and COVID and Putin, then accelerating inflation, then why do you think markets have not fallen anywhere near comparable times as 2008, 2009? As I kind of explained, I don't think the situation now is as bleak as it was in 2008, 2009. Again, I was managing money during that time, and actually, there were nights when you're getting no sleep because you're worried about which financial institution was going to go bust. We saw Lehman's, we saw Bear Stearns. We're going through prospectuses, seeing which financial institutions were involved in ETFs, where the custodian was, and we were questioning the health of the financial system. What we're going through at the moment, let's say, is a period of higher inflation, and that's uncomfortable, but it can be dealt with, and it can be dealt with by raising interest rates. You could argue that actually raising interest rates doesn't do anything about the oil price and the fact that that spiked, which is behind a lot of the surge in inflation. But actually what the Federal Reserve is concentrating on is trying to equalize supply and demand. And if they can't increase supply, then what they're trying to do is basically reduce demand. And that's what we're going through at the moment. Yes, there are probably asset bubbles out there, and I think some of those are bursting before our eyes. And here I'll talk about cryptocurrencies and NFTs, etc. I think those were one of the bubbles, which was driven by a period of very, very low interest rates. Elsewhere, again, it's difficult to argue that there's particularly bubble in stock markets. The valuations there, as I say, in the US are not cheap. They're certainly not at breathtaking levels. Yes, certain stocks have been looking expensive, and here I'm thinking of the sort of unprofitable tech companies. But actually, some of that froth has already been taken out of the system in many cases. So yeah, I'm not as downbeat in terms of the investment environment as I would have been 12 or 13 years ago. It's basically how I'd summarise that.
Excellent. Well, Justin, thank you ever so much for taking the questions and for the presentation. I'm sure it's very insightful. It's nice to have some optimism as well. I think you're right that for a lot of the clients who are effectively longer term investments, ignoring some of the short term noise is key. Yeah, that's very much appreciated. We're pretty close to time now, so it really just leaves me to remind you, give you a date for your diary. 7th of December is our next webinar date. We'll be joined by QB Partners, hosting a panel discussion on pension transfers, following on from the UK DWP red and amber flags last year. They'll be looking at ways of smoothing the transfer process for advisors and clients. But other than that, once again, thank you so much to Canaccord and Justin and Dara for joining us, and thank you all for attending today. So goodbye to all of you.
Thank you very much.